Hey everybody, Michael Martin, happy Monday. So, got a couple questions about the number of trades that you put on. And the truth is it doesn't really matter. The It's not a metric that's going to help you trade better, for example. What you would know from your own trading is your win percentage, your losing percentage, right? They have to be what we call complements, that they have to add up to 100. Of course, you might have a few that are break even, but generally speaking, you'll have winners and losers. Those percentages will add up to 100. Then you know what your average win is, what's your average loss. From there you can calculate your expected value, and you would want to know that. It gets a little trickier if you're trading several different setups and several different strategies. Me myself, I would isolate what those are so that you know the expected value of a particular setup, not necessarily of your overall trading. Once you do that, then you can use Kelly formula and some other statistical evaluations to kind of see what's the optimum number for you, right? So there's no one number that says you need to do 2 or 3 trades a day, a minimum, or there's a certain maximum, right? It all depends on what's available, your tolerance for risk, the strategy that you have. Again, you can use Kelly to help you figure out, are you going to actually hit your goals? My humble opinion and what I've been able to witness, obviously the folks who are trading intraday might have more transactions, right? Then when you have to speak though, if like you're in a big bull trend for a particular move, you can go in and out of that trend to me and still have that be the same trade, if you will. Like I don't look like, well, if like what's a good example? If you caught the breakout on Coinbase from around 80, 90, and you let it run up to 80, 180, excuse me, and you were in and out of that move, managing the risk, following your rules, that to me would be the same trade. I don't really break it down or separate it that way because for everyone, as I've said before, each trader that's out there that could be watching this show and the majority of the traders who aren't, we're all as unique to one another as is our fingerprints, right? So it's hard to say, to look at any one person and say, here's the right amount of trades that you should be putting on. Here's the maximum number of trades that you should be putting on. It really comes down to your style. So it wouldn't be like something that I would look to optimize. If you were to try to optimize it, you really have to break it down, like I said, to particular strategy, your tolerance for risk, what your expected value is, your trading capital, right? I find that there's an inordinate amount of people who watch this show that are scalpers. And in my opinion, like I wouldn't scalp because it's not enough money for all the work that you're putting in. If you have to, do it because your capital is small, then your goal should be to add additional funds outside so you can get out of the world of scalping as fast as possible. Because by definition, you're looking at putting on a suboptimal position size, probably trading these $2 micro contracts, which, it's hard to even make minimum wage doing it. So again, that's a whole different ball of wax. If you're looking intraday and you're looking at these moving average crossovers, you could be doing 50 trades a day. Hopefully, you're making money after expenses and everything, given how many hours you're putting in, unless of course it's automated. With longer term position trading, trend following style models, you might find yourself, again, depending on how you do it, getting into certain moves and holding them almost like investments until you see a reversal or whatever the exit criteria that you are looking for as far as taking your winners. If you get knocked out, because your stop is hit on losing trades, the decision's kind of made for you. Um, Again, I don't like the idea of price targets because most people kind of limit themselves with limiting beliefs, thinking like, well, I want to risk 10 cents to make 30 cents in soybeans. Well, that's great. But if the move continues to, for another $1.25, you've missed the move. So your analysis kind of served you, but then your behavior didn't serve yourself. You see? So I can't tell you to be more aggressive. which kind of alludes to both taking on more risk but also putting on more trades. It really is a case by case situation. Um, I know I'm answering a lot of questions around the same time, but what I would prefer to do is to get into the move, let the move unfold, stay in the move for as long as possible. And I'll talk about this perhaps more on another episode, but one thing that I think is clear as I wrap this up is that you need to be much more proactive in moving your stops. So, for example, one person wrote in to me, I don't want to give away their name, but they had been up 8R and they only walked away with a 2R gain on the trade. So, something's in there where they're not proactive enough, this person, to adjust their protective stops along the way. Now, somewhere in there, right, because trading is an art and science, you do have to figure out when and why and how you're going to adjust your stops. You can do it certainly based on ATR. That's a very popular way. Um, and trail with a 2 ATR stop maybe, so that every time the thing moves up, your protective stop is 2 ATR away from the current market price. You can use 1 ATR. It really comes down to the feel of it because there is an art and science. But unless there's corrective activity that happens very, very quickly, and you're not using or putting stops in, you're kind of sitting there watching it, it's kind of difficult, to coach to those things where I advocate put the orders in because there's no boogeyman there trying to run your stops. Like that's marketing language to try to put you in a fear mode to sign up for a course that or some type of Discord that I know right now you don't need. As soon as you put any stop or limit in the machine, everyone in the world is going to see it. So, you like those orders because they're there to protect you, right? The last thing I care about is where everyone else is actually putting their stops because I have to follow my own orders. You know what I mean? So the number of trades, um, now I'm starting to think like entering an order isn't necessarily a trade because a lot of orders that I put in don't get filled because I'm not chasing. I'm going to let the market come to me. So every day I'm juggling a book of stops, to manage my risk. Buy stops typically above the market to enter long and to add length, maybe to add, right? And then protective sell stops below those positions to knock me out in the event that the market does a sharp reversal. Again, in the commodity space, the things can move very, very quickly. And with the leverage, you can see bigger whipsaws in your capital, which I don't typically prefer, but it's life on life's terms. So just again, I'll close up here, getting up to 8 minutes. There is no optimum number that's good for everybody. There is an optimal number probably for you and for your style, but you would need to know a lot more of your math in order for me to kind of help you with that, right? Because think about it. High frequency traders, which to me are not really traders as much as they are programmers, they might be into hundreds or thousands of executions a day, making sense and fractions of sense with, because of their low latency and they're practically on top of the market with their server, co-location and their low to no cost so that they can add that all adds up. Maybe they pull down, who knows what every day. So I think by definition, the number of trades, just to close out here, is really dependent upon your style and the markets that you're looking at, right? If you're looking at one particular market like the stock indices, you might find yourself looking and changing time frames just to be in trades because you don't want to miss out on action. I don't know. So I can't really help you unless I knew more of your specifics. That would include, are you trading one setup or are you looking at every setup? And then what's the expected value? If you want to go do the work on your own, which is what I would recommend because it's really great to learn, is go look at that, then go look at the Kelly criterion and see kind of like, okay, what's your optimum bet size based on your numbers? And then realize like, okay, that might be super aggressive. You might do that and find out that Kelly suggests that you should be putting on 24%. You might not feel comfortable with that, even though that's what the behavior that you've exhibited suggests. So there's a lot more to it than just say, "Oh yeah, you should probably be doing a trade a day, so 25 round turns." There's no one set answer. But if you have some follow-up questions, about your trading, then leave it in the comments or write to me through the blog. As always, if you like any of this or you know somebody who could benefit, please, like and share it. Please subscribe. I get the data. It's very meaningful. Get good statistics about the types of topics that are meaningful for you. And if you haven't already done so, you can get a free copy of the audiobook version of my book, The Inner Voice of Trading, over at Martin Chronicle. It's free in the top right corner. Thanks for being here, and keep the questions coming. I'll see you tomorrow.